So welcome to today's session. I am very excited because finally today we are going to work with risk assessment at the assertion level. Sure, we started off with pre-engagement and then first understanding the entity, then overall risk assessment, and finally we are with risk assessment at assertion level. So that's fantastic news. And can you believe it, next week, Friday, we are finishing off this whole series of level 2. So next week, Friday, we will continue with risk assessment at the assertion level with a bit more, almost want to say tricks up our sleeve, a few more accounts to consider, a few more new things to consider. And then that will conclude level 2. So I really hope that you are learning all there is to learn, asking your questions. And with that, of course, please today ask any questions that you still have that you are still thinking of. On the agenda for today, we are going to start off with looking at where are we today? What have we done? Where are we in the audit process? We will have a look at the map for today specifically. What are we going to do today? Just have a little bit of a reference to the understanding of the entity. You might remember in session 3, we looked at the house in terms of understanding internal control, and we left 2 parts of the internal control elements to this session. So we will just finish off with those bricks that we still need to add to our house in terms of control risk. And then we're going to continue on to doing the risk assessment, looking at the audit flow, what is involved, and then go into our breakouts for either our probe audit methodology to see what it looks like in the documents, or go to the AI session, or rather you guys stay. Hey? So you will stay for the audit AI session to see what your working papers are going to look like. So in terms of where we are, what have we done? So in the audit process, we've got the client acceptance and continuance, which is where we started right at the beginning. We have the planning section, which is really what we're still busy with. We have the execution, which is level 1, and then finalization of the audit itself. Now, we are in this series, level 2, planning the audit. And we started off getting an understanding. We had done some risk assessment, and we have started with our plan and strategy. But as you will remember from the other sessions, those arrows indicate the iterative process that we are busy with. And so you will always be continuously updating your understanding while you're updating your risk assessment. And as those improve or increase, you might be amending your audit plan and strategy as you carry along. Right, so that's where we are, and we will still be busy with that today. In terms of what we are going to focus on today specifically, as we said, we're going to continue our understanding of internal control and completing our house with those last few bricks. We are going to consider control risk in our risk assessment process, identify the overall and assertion level risk, then assess the levels of risk that we have and decide on the work that needs to be performed. And the NET there is the nature, extent, and timing, or some people may know it as NTE, the nature, timing, and extent of the work that we will be performing. Right, so that's really getting to the work program steps complete. Have the steps completed in the work program. In other words, which are the steps that we need to do so that when we get to the fieldwork stage of our audit, we will know what needs to be done. Right, so still no fieldwork today. The fieldwork we had already done actually in level 2, in level 1. Today in level 2, we are simply planning that. So it might feel a little bit, contra to what you would normally do. But remember also that when you were first a junior, you first just did the work that someone else told you what to do. And now we are at the stage where we can decide and have enough experience to be able to decide what needs to be done. Right, so let's start then with our understanding of the entity as required by ISA 315 revised 2019. I'm sure that this house will look familiar to you. You'll remember from last week or the previous session, then at least session 3, where we said the control environment is like the roof to the house. If the control environment is not properly designed and developed and implemented, we will not be able to protect what is inside of our house. And so we first went ahead and looked at the fact that we needed our control environment to be properly in place at the client. We considered some of the bricks. We considered the indirect controls being the risk assessment process and monitoring as part or linked with, or the third element to the internal control. And then level or element 4 and 5 of the internal control elements or parts is then control activities and information system and communication. And they are intentionally in a separate line. Those are what the standard refers to as direct controls. And so they are more directly linked to the control activities or the classes of transactions and account balances and disclosures. So that's what we're going to consider today when we get to that point of actually considering what the risk assessment is at assertion level. Right, so first of all, we've got the information system and communication as an element or a part of internal control. And I think the first thing that's important to remember here is that when we refer to information system and communication, we are not just referring to IT, in other words, information technology. We are referring to everything in the information system and the communication thereof. So basically, as soon as we've got a risk identified for materially misstated, that a specific account or class of transaction, any of those could be materially misstated. In other words, when we have a relevant assertion, we will have a so-called significant class of transaction, account balance and disclosure, or SCOTBD, right? If that confuses you completely, just remember whenever I have identified and recorded a risk for a specific class of transaction, account balance or disclosure, then the standard says I must obtain and document a system description. That's really obtain an understanding of the information system and communication. Now, on the right-hand side of the slide, you will see something which I'm sure is going to be familiar. So in level 1, when we did the field work, and even previously when we looked at some of our other understanding, every single time we ask ourselves, how did the transactions end up in the financial statements? How did this balance, how did this disclosure end up in the financial statements? And we basically traced back to say, well, there was some action. There was either something paid, or we employed a person, or we incurred an expense, or we made a sale. Something happened. There was an action. There was then a source document. That document had to be recorded either in a subledger, in the cash book, in some or other documentation, which was then recorded in the general ledger and updated to the trial balance, and of course ultimately ended in the financial statements. You'll also see that part in the second last circle with other, right? So we also have other information that can land in the financial statement. So if we say, for example, have a lease payment that is processed in the cash book, updated to the general ledger, and then ultimately recorded and disclosed in the financial statements. It's not just the lease payment that gets disclosed in the financial statements. We also have the commitments for that lease that is disclosed in the financial statements. So that information is not recorded in the cash book or in a subledger or in the general ledger for that matter. The lease commitments will be included in the lease agreement, which is something outside of the accounting record. So the information system and communication, the system description that we need, must include everything as part of the system description, not just the what document is used, how does it land in the financial statements, but also any subledgers, any other information that's necessary that the client uses. Also, what some effort or some specific elements that we need to consider in terms of information system and communication is the financial reporting process to prepare the financial statements, right? So sometimes the system descriptions, I was going to say, stop by the time it reaches the general ledger or when it's recorded in the trial balance or something like that. But we shouldn't just stop by the subledger or the general ledger or maybe the TB. We should go all the way to the financial statements. And then also to consider is how management would communicate significant matters in the processing of these items and ultimately getting to the financial statements. So, for example, how did they communicate these significant matters between people within the entity, maybe different departments, the stock or manufacturing section or the department versus the accounting staff? Okay, how does that get communicated? Because it doesn't help if the accounting department only hears of items that had already been accounted for, processed, etc. after the fact. Sometimes they can actually provide information as the transactions take place and ensure that they are accounted for correctly. Between management and those charged with governance even, so those charged with governance are of course the individuals, well, one or more individuals who have who decide on the business strategy, and management are the ones responsible for implementing the business strategy. So again, to say, how are these individuals or groups of individuals communicating with each other about significant matters that will ultimately affect the financial statements? And lastly, how is all of this communicated with external parties, right? So that all of those elements are what makes up the information system and communication. And again, I want to remind you, with a significant risk or a significant area, we need a system description. Of course, you are welcome to add additional system descriptions. So there are some auditors who have policies that will say you need to document more system descriptions, because that is how we are going to understand how the transactions land in the financials, and therefore how we are going to understand where there is a risk of material misstatement. So the minimum is to record the minimum is to record a system description for a significant risk. Sorry, no, not a significant risk. Now I'm confusing myself. That is this thing where we talk about significant area or a significant class of transaction account balance disclosure. A SCOTABD. So when there is a risk, any risk. I think there's exactly a question coming in here. Let me see this question. Yes. So you only have to, as a minimum, do a system description when you identify a risk for a class of transactions, account balance, or disclosure. And I've got those definitions a little bit later on in the slides as well. So when I am just doing risk assessment, there's no specific requirement for me to obtain an understanding of the system descriptions for specific accounts or classes of transactions. When I can, of course, record system descriptions. When I identify a risk of material misstatement, in other words, I go and record an inherent risk, then I need to also get a system description for that account balance or class of transaction or disclosure. When I identify or assess that risk as a significant risk, then there's another step, which we will see later on. So I don't need a system description for every account. When I do have a risk, I need a system description, and then it's also possible that I could have a significant risk, and then we'll have another step for that. Okay, I hope that clarifies the question. Good. So let's have a look at the process then. So we'll have the action, the source documents. I've mentioned the subledgers. All of those parts will happen. And when we have a system description, we need to consider all the steps. We need to consider all the documentation involved, but we also need to consider who does what. And when we document who does what, it's not just about Johnny, Susie, Peter, whoever needs to do something. We must also mention their role, because next year there may not be a Peter in the stock department anymore, but there may be a Peter in another division, and then we're going to confuse people. So it's important that we document not just who, but also the role that they are playing. Probably their job, not their job description, their job title. Right, and also consider if there's any information technology involved. Right, so manual and IT is mentioned here, not just the IT considerations, everything that is involved. Also, if things are going wrong, if they make a mistake, how are corrections done? So can anyone just fix anything that they make mistakes on, or do they need to actually go through a specific approval process to correct mistakes that they make? Everybody makes mistakes, so that's perfectly fine. The question is just, do we need specific authorization to make mistakes? Because if not, that could possibly give someone an opportunity to go and change stuff after they were recorded initially. So then it almost doesn't help that we have a beautiful process for correctly accounting for stuff if people can change it afterwards. And then to consider any events or conditions and ask ourselves if there are any other points that could actually influence the financial statements. Right, and then in terms of control activities. So the first step, we need to obtain a system description. I always think about this as the flow of information in a tumble dryer. So the information just flows, and what is the end result? I hopefully have clean or dry in a tumble dryer, dry clothes. But what happens inside that system description are a lot of things, and some of those things are not necessarily going to result in dry clothes. They just happen to happen there. So the system description is the flow of information, the documents involved, etc. But then we need to also go and focus on control activities. So controls being those things that the client puts in place to make sure that the transactions and events that are recorded in both the accounting records and ultimately in the financial statements are correct. In other words, there are no mistakes when we are recording them, so preventing material misstatements. And if they do happen, remember just now I said mistakes happen. So if we do make mistakes, how do we pick them up? How do we see them, identify them? Or the fancy word, how do we detect those misstatements and then not just keep them and let them be, but to correct them. So see that there's a mistake and fix it in the accounting records. So the client will have to basically design and implement control activities to ensure that not only do we understand that the information flows and ultimately gets to the financial statements, but also the client has put certain steps in place, which we refer to as control activities, to ensure that there are no mistakes either made, mistakes are prevented, or if they do happen, they are detected, picked up, found, seen, and corrected. All right, now the standard says you must, after doing your system description, you must identify and document your control activities for the following 4 instances, scenarios, categories. What are those 4? First of all, I said when we have significant risks, we're going to have a second step. So the second part then, or the next part with significant risks, is not just to document what is the system description, but a second step to say, okay, and what controls did the client put in place? Not just over the system description, but specifically to address this significant risk of material misstatement that I've identified. Right, so the control has to specifically or directly address that risk. That's the first instance when we need to go and understand and identify control activities. Secondly, controls over journal entries. You might remember from a previous session that we had a specific response to the fraud risk for management override of controls was to say we are going to go and consider controls over journal entries. So probably they're not a surprise to you in this scenario. Then the third one is to say that when we want to or plan to or believe it will be effective and efficient for us to test the operating effectiveness of controls, well, guess what? We can't test controls if we don't know what they are, if there are any, what they are like, if they are good or bad or not even there at all. So, of course, it makes sense then to say if we want to go and try and test controls, we have to first go and see what are the controls. And then lastly, when we get the scenario where other controls that we consider necessary to perform the risk assessment. So if we need to actually get more information. So just to also confirm here that controls are basically designed to ensure that the policies are applied in the firm. Right, so types of controls that you might have seen already, and even some of the documentation have these, I just want to say fancy words, big words: authorization, approvals, verification, segregation of duties, having more than one person do certain parts so that one person can't do it all by themselves, and then physical controls, and then more an IT type, a logical control. All right, so you're going to see those words again. Then, when you have identified those control activities, you also need to ask yourselves whether there are any IT applications used by the client that will give rise to IT risks. Right, and if there are IT risks, then we have to go and consider what general IT controls the client has in place. This is a tricky one, and we often forget about this because we cannot just ignore the impact of the computers anymore and of technology. We have to consider the impact of technology. We have to also take that into account in our risk assessment. And then the standard, or a lot of us just refer to D&I testing or D&I consideration. When the standard says we have to go and identify these controls, we have to ask ourselves if those controls, the way that they've been designed, that's the D for D&I, the way that they've been designed, will they achieve the outcome? Will they achieve the objective of that control activity? So the control over significant risks, will that control actually prevent or detect and correct the significant risk that we've identified? Over journal entries, will that control ensure that only legitimate approved journal entries are actually processed, and so we can carry on? Right. Implementation test. With implementation test, that is where we go and check that the client doesn't just say, oh, this is our policy, this is how it should be done, this is the procedure. We want to also see that it actually looks like the client is actually doing that. So with the implementation test, it's not the only way to do implementation test, but I'm sure a lot of you will be familiar with the concept of a walkthrough test, where we literally take a transaction, and I'll show you some examples later on, literally take a transaction and walk through the process of the information flow to see that the controls did in fact happen. All right, you could do an implementation test in another way in certain cases, but in the majority of cases, a walkthrough test just makes the most sense. Good. Let's just have a look here at the difference or the interaction between a system description and the controls. To remind ourselves again, I need a system description whenever I've identified a risk of material misstatement. I must identify controls whenever I have identified a significant risk, when I'm looking at controls over journal entries, or when I might want to rely on controls for getting efficient audit evidence. Now, in the system description, remember the orange or the coral circles that we had earlier on? That was the flow of information. That's just where we documented what documents, who does what resources are used, all of those parts. And then you've got these little yellowish things that happen in between. And those are basically our controls. There might be something that happens between the action and the source document that ensures that all actions are actually ending up on source documents, the completeness control objective, or that only valid actions end up on source documents, or that the information on source documents are accurately reflecting the action. So our 3 control objectives that you may be familiar with: completeness, validity, accuracy. All right. And so basically, you can go and ask yourself everywhere, where can things go wrong? How does the client ensure that the accuracy, the validity, and the completeness of the information is ensured? So let's have a look at an extract from the system description. On the left-hand side, the system description, or a part of our system description, says that purchases of raw material are processed by Jane X, who is our creditor's clerk. No one else has access to process the purchases of raw materials. That's the information. Now, what is the control? The control is that only the creditor's clerk is able to process raw materials. Right, that's the control that we identify. We're not yet at the point where we're saying, are we testing it or not, or what, but that is what we are currently sitting with. Then when we go to the next step and we say, okay, what are key controls? I can have a lot of controls, but key controls are what I link to a specific risk. Controls that address a specific risk. So the risk that we've identified in our system description, still the same system description from a picture from earlier on, the risk that we've identified is that there's a risk of unrecorded liabilities, specifically in trade payables because of a delay in processing. So that is the risk of material misstatement. We say there is a possibility of unrecorded liabilities. So we go and we look at the system description and we go and identify the information. So already we've said process of raw materials are processed by Jane, the creditor's clerk. No one else has access. And we said a control in the system is that only the creditor's clerk has access. Is that control addressing the risk that we've identified of unrecorded liabilities? No, it's not. It's not helping to ensure that all transactions are recorded timeously. It's not doing that. It's not preventing a delay in recording the trade payables. So let's have a look at another control. So if we continue looking at our system description, there's another part to the system description. This is a bit of a longer one that says Jane receives statements from creditors and then follows up if one of these is not received. So if she doesn't receive a creditor's statement, she follows up. But the payable age analysis is reflecting a balance. So she's recorded a transaction, but she doesn't receive the statement from the creditor. She will then perform a creditor's reconciliation with that statement between the statement and the creditor's ledger every month. So what is the control? The control is a creditor's reconciliation is performed every month. Is that a control addressing the risk of unrecorded liabilities? So saying, because there is a delay in processing the invoices from suppliers, Jane doesn't just wait for that. She actually goes and she performs a monthly reconciliation with the creditors between the statement and what has already been recorded. So that if there is an invoice missing that is not already been processed, it will hopefully be reflected on the customer's statement, and therefore we can ensure that we are picking up any of those missing or not yet recorded invoices from the supplier. So is that a key control? Is it addressing the risk that we've identified? Absolutely, it is addressing the risk that we've identified, and we can therefore identify, or I was going to say, classify that control as a key control that we may want to rely on if we decide to, but something that's definitely potentially addressing the risk that we've identified. Right, so that is just some terms and the interaction between the system description, the flow of information, the controls, where we say, well, the controls are the ones that ensure completeness of the information, validity of the information, and accuracy in terms of the control activities that the client has put in place. And then the key controls are the controls that are specifically or directly addressing the risks we have identified. Right, then control risk. Let's consider then control risk and the assessment of control risk at assertion level. I know this is quite a lot of theory and probably not the most exciting information, but it is necessary for us to go through this theory before we can actually get our hands dirty. So just bear with me. We will have a look at some more exciting things towards the end of today's session, and then next week is going to be a lot more hands-on practical recording things ourselves. But we need to first ensure that we have a good grasp of the theory and what the standard requires of us. All right, now if we consider control risk at the assertion level, the control risk is defined as a risk that the control will not, as I said before, prevent or detect and correct a misstatement. So whenever the client has said, where can things go wrong? Where can I get a situation where the information will actually be incorrectly recorded? Let's put a control in place. And then the question is, will this control prevent a material misstatement, prevent things from going wrong? Will it detect or any of those ones? All right. If we don't identify a control, then the standard says, in that case, control risk is merely the same as the inherent risk. So then we're not increasing inherent risk just because control risk is, or just because there is no control, or just because we're not relying on controls. If we don't have any controls, when we're not testing on relying on controls, then control risk is exactly the same as inherent risk. In other words, then you just ignore the impact of controls, which, if you think about it, is actually what we do when we assess inherent risk. Inherent risk, when we say, what is the risk of a mistake happening in the financial statements? What is the risk of a transaction being incorrectly recorded in the accounting records? And there the standard says we ignore the impact of controls. So we assume there's no controls. What is the risk of material misstatement? And then basically the only impact that the controls could have is basically to lower the overall risk, to basically decrease the risk of material misstatement. All right. So we will assess the control risk at assertion level when we are planning whether to test the operating effectiveness of controls. Only then. Otherwise, it doesn't matter, and we can basically we're basically then neutral on the control risk. Okay. And that's why perhaps if you've never considered, or if your firm maybe has a policy where you hardly ever test controls or rarely test controls, you might not even have thought about this before the time. And in fact, also Probe actually has a bit of a strange way of looking at it. But you'll see for the AI guys, maybe it's a bit more obvious for you. For the Probe guys, you'll see it in a bit of you'll see it in the work program, not as an afterthought. That's the word I wanted to use now. But you'll see that when you don't test controls, you're pretty much just neutral on it, and you don't document it as part of your planning stage so much. Right. Then if we think about risk assessment, so in risk assessment, sorry, let me just quickly see something here. In risk assessment, we need to now go and consider what is the risk that the financial statements may be materially misstated. So even though we started off earlier and we said, well, we're going to do overall risk assessment, and I started this morning's session and said, finally, we are at the assertion level risk assessment. Let's just see this again. What is the difference between these two? So when we are assessing overall risk, we are considering what is the risk that the financial statements as a whole, overall, any or many accounts everywhere or completely could be materially misstated. So there could be a mistake in the financial statements for wrap-up manufacturing that is so big that it's just affecting everything. That's an overall risk, whether it's inherent, control, or fraud risk. But then when we get to the assertion level risk, which is what our focus is going to be for today, we will go and look at, drill down into the financial statements and specifically look at things like trade and other receivables, and then go and consider an assertion being valuation of the trade and other receivables. So we're definitely drilling down into more focused, more specific, and therefore you're going to see that we're going to literally look at every single item that is disclosed in the financial statements, and for each of those we are going to look at the assertions. If you hear a little bit of silence every now and again, I seem to be sneezing and coughing and whatnot, so I apologize for that. I try to just mute myself so you don't have to hear all of those. All right, but I'll try and limit them as far as possible. Good. So in assessing assertion level risk, we firstly then have inherent risk factors. The standard says that in identifying whether there could be a risk, there are a few things we can think of, consider when we look at each of these accounts, classes of transactions and disclosures. Now, just important again, we said inherent risk is assessed before considering the impact of controls, and then also that the factors are so-called characteristics of events or conditions that has a susceptibility to affect the assertion to the statement. So in other words, these are just things to consider. They're not saying the moment you see this, there is definitely a mistake. That's not the case. It doesn't say the moment you see this factor, there is definitely a risk even. It says consider these factors. If you find these factors to be present, consider if that is indicating that there is a risk of material misstatement, right, for this assertion. These factors can also be considered at overall level. Very often we might not necessarily think of them as such, but then also when we get to recording or doing the risk assessment at assertion level, it's almost like they become more explicit for us in this consideration. Right, let's see. You can see the table already, but the table, of course, is blank. So let's start building our table. Oh, maybe just another thing also in terms of what these factors are. They're basically like an element or a feature or a something. Okay, so this fancy words from the standard says they are characteristics of events or conditions, but it's a something that can tell you that maybe something can go wrong. But remember, I said it's not definitely telling you there's a risk. It's not definitely telling you there's a misstatement. It's just telling you there might be a risk of material misstatement. Good. First one is complexity. So we consider what is the nature of the item and what is the way in which it is prepared. So in the way in which it is accounted for. Maybe the stage at which you are allowed to account for it. So I'm not considering the uncertainty yet, but just thinking about complexity, about things that are really difficult to calculate, really difficult to determine what is the right way to do it. Okay, so that could be a first indication that this is really difficult to do, and so therefore there might be a risk that the client actually got it wrong because it's difficult. Okay. The next factor to consider could be subjectivity. Now, subjectivity is defined as a limitation in the ability to prepare information in an objective manner that results in judgments being made, or it could also indicate that there is knowledge, or let me rather say that there's a limitation on the knowledge or a limitation on the information available. So the subjectivity is because we almost want to say we don't know. Okay, information may be there, but or I also might not necessarily know. So there's a judgment involved, and it's because of a limitation in the information, and therefore I can make the wrong judgment. That's subjectivity. If we go to change, well, things change. So there was an event or a condition which over time affects the business's environment or the operational environment, and because of that change, we can now have a scenario that could lead to a mistake in the financial statements. So we'll have some examples shortly, but that is definitely then also something that because something changes, maybe the business changes, maybe the business changes the what is the word that I'm looking for now? The business changes the way of business, or they're expanding and they're opening up new branches, and the way that they need to account for all these new branches where before they were just one shop. Maybe those kind of things the change in that, the mere fact that there's a change could have an impact. The interest rate might change, this might change, whatever might change could have an impact on correctly recording it. And also now that I think about it, as we are building up through these factors, it's quite possible that you might also have more than one factor that is present, and therefore, I almost want to say, it convinces you more sometimes that actually there is a risk of material mistake. Doesn't mean that the more factors are present, the more your risk is, not at all. But I'm almost rather saying that sometimes you'll find that there are actually two of these factors present that kind of just gives you comfort that yes, actually there is a risk I need to record. All right, so change also, and that's why sometimes you'll see there's a change and complexity. Things like that could actually then combine your identification of inherent risk. The next one then is uncertainty. So if there is uncertainty in the accounting or in what to record or when to record or anything like that, that could also lead to an inherent risk. Don't confuse the subjectivity with uncertainty. With subjectivity, we said there's a limitation in the ability to prepare the information because we don't know. With uncertainty, the information actually just physically cannot be prepared on a precise way or in a comprehensive manner because the information is not available, not because we don't know, but because the information is just not available and it's not in the control of management. So in subjectivity, for example, it's possible for me to make a judgment call and to say, this is what I'm going to go with without having done the appropriate research to get the right answer. Whereas in uncertainty, I actually don't know what's going to happen. So I can't give you the answer. It's not that I don't want to do the research. Nobody knows what's going to happen next week. All right. So that could be an uncertainty element. Of course, again, you could sometimes have subjectivity as well as uncertainty. Right. Then the next one is susceptibility to misstatement due to management bias and other fraud risk factors. So fraud risk factors, but also the susceptibility to management bias that leads to misstatement. So it's that, I almost want to say the common or the one that we are aware of in terms of the fraud risk, but also other fraud risk factors. That's not necessarily then management susceptibility. That would indicate that there are conditions that could create bias, okay, where we don't have the neutrality because people are wanting to actually commit fraud or have an incentive to, etc., etc. So these are then the 5 specific factors mentioned, and the standard, of course, also then says, and there could be others. Okay, so there could also be other factors, but these then being the 5 defined ones and others. So could, for example, also be, if I just think about something that's very topical at the moment, in terms of group statements, if there is a consolidation risk or a risk that a specific balance at the consolidation pack could be misstated, materially misstated, and specifically because of the fact that there's a eliminating journal or something that might be a bit tricky, or people might be uncertain or anything. But then the fact that there's a consolidation could also be what leads you to actually recording the inherent risk, and that would then fall under other. Okay, as I mentioned, the uncertainty and those things could also play a role, but the consolidation could also then be an additional factor if you want. Right, I've talked a lot. Have a look at this group again, at this table, the 5 different elements, and then we're going to do some polls here to see which of these factors are present in the examples that we're going to see soon. All right, just remember again, you identify inherent risks before considering controls, and these could also be applicable to both the overall or financial statement level risk assessment and the assertion level risk assessment. So let's jump in and do our first poll. All right. So for each of the polls, I'm first going to show you the slide because the scenarios are a bit longish and I couldn't fit all of them onto the poll itself. So I'm going to ask you in the poll to identify the inherent risk factor. That's going to be the task in each of them. What is the inherent risk factor that is present in the scenario? First one, in determining the provision for supplier rebates with different commercial terms with different suppliers where the calculation is also quite difficult. So let's see, when I launch this one, which one is the inherent risk factor present in this scenario. So just to see the results then, the complexity has definitely won. 70% of you said this is indicating a very difficult calculation, and so I will choose complexity. And that is exactly correct. I see 13% said subjectivity, and if we look at subjectivity there, the definition, it says that there is not information available. Now with supply rebates, maybe just to clarify that, supply rebates are often where you can get money back from your client, from your supplier rather, when you buy a certain number of or a certain amount of items from them, and they will basically give you some money back. Those would be the rebates. So it's almost like a discount, but you only get it later on when you've reached a certain level of purchasing. Okay, that's my word, discount. It's not technically correct. It's just like a concept. You're getting money back. So there's no judgment involved there really. There's a specific term, there's a calculation, you do it, but it is a difficult calculation. So that didn't change. So the 6% in change, not quite. And fraud, I guess there could be some fraud risk in the sense of possibly trying to manipulate it, but that's not the primary one today. The primary one that we were trying to get to was the fact that it is a difficult calculation, different commercial terms and multiple suppliers. So definitely not an easy thing to calculate. All right, so that was number one. Let's see number two. Number two then is an inherent risk factor that we want to identify in the case where we are calculating useful lives and residual values of property, plant, and equipment in a manufacturing entity. So let's see, with the options we have here, complexity, subjectivity, change, and uncertainty. Almost thought I saw a little typo there, but thankfully not. So what is the inherent risk factor in calculating the useful lives and residual values of property, plant, and equipment in a manufacturing entity? Is it complexity? Is it subjectivity? Is it change? Is it uncertainty? Right, so when we calculate the useful lives and the residual values of property, plant, and equipment, those are determined when we purchase the item, and in IFRS every year after that we need to reassess those, and those are saying that if this item of property, plant, and equipment was at the end of its useful life now, what do I believe I could sell it for? That's the residual value. And useful life is how long do I intend to use it? So there might be some change from year to year if that's the case, but even just initially there's not really much change. It's difficult to determine that in the sense that, well, there's not always evidence for that, but I wouldn't say it's a difficult calculation. So I wouldn't say it's complexity. But what we can definitely see on the results from the poll is that subjectivity sitting at 59% and uncertainty sitting at 23% is definitely, we're not always sure, is it now subjectivity, is it uncertainty? It doesn't really matter. It's almost like an academic thing here to consider. But uncertainty, remember, is because we just don't have the information, and it's because the information is not available from a preciseness perspective. Whereas with subjectivity, management might not just have the knowledge, or might make might make a judgment mistake, or might make a mistake because they are making a judgment call in limitation of their consideration of everything involved. So it would, to some degree, rather be, if we want to go with that, I almost want to say the primary one would probably be subjectivity rather than uncertainty. Not that uncertainty is wrong at all, but those then being the case. Right. Remember, I said it's almost like an academic consideration. So I'd rather want to just help you and take you through the consideration on the thought process than necessarily wanting you to get it 100% right in any case. All right. I do think that perhaps we need a little bit of a comfort break. What I'm going to do is to give us a 10-minute comfort break. And then after the break, we're going to just quickly look at the table again, just to make sure everybody's fresh. And then we'll do a few more of these because it really helps us to just think about it and to be alert and see what each of these could actually be from a practical example perspective. Welcome back from the break. I hope you had a good coffee, good break, stretch, whatever it is that you needed. I thought we should start the slides again, or the session, by just quickly looking at the factors again before we continue with the polls, just to see and refresh our memories again. So we've got complexity. The way in the item is prepared is difficult. Subjectivity, the limitation in ability to prepare the information in an objective manner, resulting in the judgments being made, or the fact that there's a limitation in the information or the knowledge, and therefore we could maybe not make an objective decision or an informed objective conclusion. Change, things that change and therefore lead to a possible change or possible misstatement. Uncertainty, the information cannot be done precisely or calculated or determined precisely because there's not information required for that, and that lack of information is not within management's control. And then lastly, the susceptibility to misstatement due to management bias or for other fraud risk factors. Right, so those were our limiter or our inherent risk factors. So I'm just quickly going to go past two of the polls that we've then already done. And then we are going to start our third poll. So this one, which inherent risk factor is present when there were amendment changes to the accounting standard which apply to a company that is being audited? So the client, I don't know, it applies, let's say IFRS or IFRS for SME, whichever one of the two, and there's a change in the standard or standards that the client now has to apply. So which of these inherent risk factors is then present? So in terms of the results, we had 84% of you voted for change. Exactly, the standard changed, so that was quite obvious. I love the fact that there were a number of people, 11%, that said complexity. Hey, if it's IFRS that changes, it means it's difficult. It's got to be complexity, right? So yes, it's quite possible that it might also have been complex. Maybe there was some subjectivity, maybe there was some uncertainty about how to apply it, but the primary inherent risk factor that's relevant in this scenario will definitely be change, as you have indicated. All right, the next one. Which inherent risk factor is present when we consider performance incentives? So the client has performance incentives, and we need to consider whether this is potentially going to, well, firstly, we are saying that that is an inherent risk factor. Which one would it probably be? We are saying there's a possibility, or there could be a possibility of material misstatement. If there is a possibility of material misstatement, or if this has an influence, which one would it be? Complexity, management bias, or another fraud risk factor, change, or uncertainty? Management has performance incentives, and we are saying that is something that we need to consider. Complexity, not so much, 3%. Uncertainty, 6%, we don't know. But by far the majority, 91%, say this is possibly going to be a fraud risk factor. Why? Because now management has an incentive or perhaps pressure to actually manipulate figures so that it can look as if the business has done well, and therefore they can be rewarded financially. Right, so that's definitely the factor of management bias or other fraud risk factor. Right, then the last poll in our list is, again, which inherent risk factor is present when we consider the client tells us there's a court case and we know that they might need to actually disclose information about the court case in the financial statement. So we know that they need to disclose the information. We know information has to be in the financial statement. So it's going to affect the financial statements. Which factor is the inherent risk factor that we're going to consider? Complexity, management bias or other fraud risk factor, change, or uncertainty? Let me launch this one for us. So yes, I agree. There is uncertainty in what the results are going to be. And for management to actually make that judgment as to what needs to be disclosed in the financials can be a difficult thing because they don't have the information, and it's not because of anything within their control. Then it could also be complexity. It is difficult to determine maybe what the fee or the financial loss is going to be. And then it could also possibly be management bias, I guess, if management is biased towards saying, oh, no, this is not a problem. We're going to win this court case. It's not going to be an issue, anything like that. If you think about possibly clients suffering losses because of warranties that weren't being kept or products that were defective, things like that could really result in big court cases. So it's possible that management might say, no, absolutely, we're not going to record this possible big payout that we need to make. So we're going to rather just pretend that it's not going to be there and then try and push out the court case as long as possible, and hopefully it goes away. We know they don't always go away, right? Okay, so that was then absolutely that one, the last poll being possibly uncertainty, possibly being management bias. Right, so this is then the part where we've said, all right, in identifying and assessing risk, inherent risk specifically, we had these 5 inherent risk factors and others as could be relevant. And so once we've then identified the inherent risk factors, we've considered whether that's an indication of whether there is a risk of material misstatement, we will move on to assessing how big that risk is. And the first step then in considering how big that risk is where the standard requires us to consider the likelihood, so the possibility, the uncertainty part, if you want, and the monetary impact. How much money is going to be wrong? What is the value? How bad is this going to be when it does go wrong? So the likelihood and the magnitude, or the likelihood and the monetary impact, is what we need to consider. And then you will basically plot the combination of that. Let me put on my spotlight, on my laser pointer, and just indicate. So if we say it is going to be, there's a high likelihood that something's going to go wrong, but you know what, even if we get it wrong, it's only going to be a teeny tiny mistake, so it's going to sit there, yes, high up, but only on the very far left. Or maybe we say, well, it's actually a small mistake, small likelihood that something's going to go wrong. So on the likelihood axis, we're going to actually just keep it here towards the bottom, but the monetary impact might be medium, and so therefore kind of in the middle of our table. Right, so that's how you can end up in a variety of these items, and you can see as I move towards the right there, you can almost not see that red anymore with my pen. So that's how it can actually move around. Now, that's the first point then, to say consider or assess the likelihood of this going wrong, of this mistake actually happening in the financial statements, and consider the monetary impact. Step one. Step two says, when you then look at this and your result is somewhere near, let me just get my proper pointer there in the corner, somewhere near the top or the upper end of the spectrum. So it doesn't have to be exactly there. Okay, this is not a mathematics or a mathematics exercise. So if it's somewhere towards the top of the upper end of your spectrum of inherent risk, then you must consider if this is a significant risk. So we like to point it out with this little cross over the rather top part, but it could also be that we have it in the, let's say, the fourth column, but the top line, or maybe even fourth and fourth or something like that. But at this moment, then I've got a high likelihood and a high monetary impact. The standard says you have to consider whether this is perhaps a significant risk. What is the definition, if you want, of a significant risk? A significant risk requires a specific response to that risk. The auditor must not just go and test a balance or class of transaction to go check that everything's complete or something. If you have a significant risk of completeness, you have to go and specifically go and perform procedures to respond very directly and very, I almost want to say the word expressly, to that risk. That it might sound funny on your ear if you think about it. Well, we only really perform work to address risks. So how is this different? But you might find that you can actually do more work. You might select more items. You might possibly even do your detailed or your predictive analytical review in more detail. Do two procedures rather than just one. Whatever you feel is necessary to get to a point where you have addressed the significant risk of material misstatement satisfactorily. All right, good. So that brings us then to the audit flow. Once we've assessed the risk, the inherent risk, we then get to saying, right, now I need to go and respond to it. And how will we respond to those? Now, maybe just first, let's look at a few terms. So some auditing definitions. We have maybe referred to some of them before as well, but just so you've got them. So first of all, a relevant assertion defined in the standard. It says that it is an assertion about either a class of transactions, account balances, or disclosure, right? So a category, class of transactions, account balance, or disclosure, is relevant when it has an identified risk of material misstatement. What does that mean? It means that you have identified a risk of misstatement. You have identified an assertion that could be wrong in this class of transaction, account balance, or disclosure, and that assertion is now called a relevant assertion. There's a risk for that assertion. And just a reminder again there in the definition that it is before considering controls. Next then is a scottabody. We had that earlier in the session, a significant class of transactions, account balance, disclosure. Now, very important, before I read the definition, a significant class of transaction is not a material class of transaction, right? It's not a material class of transaction. And it is not a class of transaction for which a significant risk has been recorded. Why they chose to use the same word, I don't know. But a significant loss of transaction, account balance, or disclosure, so a scottabody, an important if you want, a risky, if you want, class of transaction account balance disclosure is defined as a class of transaction account balance or disclosure for which we have a risk, for which we have one or more relevant assertions raised. And when do we raise a relevant assertion or have a relevant assertion? When we've got a risk raised. So this is very important that you don't confuse this. When I have identified an assertion that is possibly materially misstated, which I need to go and audit, that is a relevant assertion. The class of transaction or account balance linked to that is then my scotability. And in some cases, the risk for that significant loss of transaction account balance or disclosure, the assessed risk may be a significant risk. All right. So I hope I haven't confused you. Make sure you download the slides if you need to, and just make sure that you don't get confused between that, because the definitions or the terminology in your methodologies will also refer to these, and then you need to know exactly what you are referring to. So the relevant assertion, we've said, that's created by the risk, and a scotability is any section with a risk, not only significant risks. Good. Then the audit flow from that risk. When we have identified and recorded or raised a risk, what happens there? We then have a relevant assertion, like we just said. When I've got a relevant assertion, I've got a scotability or a significant loss of transaction. I've got a section with a risk. Earlier on, when we considered what do I need to understand about the control activities, we said I must understand not the controls necessary, but I must understand the information system and communication. In other words, I need to have a system description for that class of transaction account balance disclosure with a risk. And then I must go and do audit work to address that risk. So that's relevant for all scenarios, not just significant risks. And what we're going to do then today, when we go to the methodology and go and look at the documentation and the planning, this is what we're going to stick with for today. So next week, when we then move into our last session and our next little examples or our next few accounts, we are then going to start looking at what happens, how is this different when I have a significant risk. Right. So for today, we're going to look at, I've identified and raised a risk. I've got a relevant assertion or more than one. I've got a class of transaction with a risk. I must then get my system description, and I need to design audit procedures to be performed. All right, that's that. Good. Just before we then do our breakout session, I want to just confirm next Friday is the 5th of April. We will then complete our last session. Again, will be from 9 to 12. We'll do the risk assessment and planning the responses for the presumed risks. We'll look at revenue. And I seem to think there's another one, but I can't remember what the last one is. So that will be next week's session. For today, then, we are now going to move to our breakout session.